All right. Well, let's a wrap, if you would, on some of the major news items, Michael. I'd like to transition the segment here to the analysis stage. And with that, what we'd like to do, folks, on the show at this point is we have some major news items. We frame it up and we take a deeper dive, if you will, around the ESG, environment, social governance issues facing corporations. So with that, Michael?
How deep should we go?
Quite deep.
Okay.
All the way.
So this is two segments, right? Truth and performance and connect the dots. So I'll take truth and performance first.
Absolutely.
And we'll dive in. So we're going to cover continue the sustainable investing side is look at some financial indexes, some regional rankings, and then some hot new mid-cap companies that are really driving the sustainable supply chain, the global clean energy markets. So our first one that we're going to look at would be the NASDAQ QCRD, which was recently reconstituted in May. And then we'll look at the Southeastern Corporate Sustainability Rankings, which just had their award ceremony down in Atlanta on May 1st. And then we will look at the Seacrest Global Clean Energy Index last. So let's do the NASDAQ. So every May and November, we reconstitute the index, and we've seen nice stability over time, that there's not a lot of companies coming in and out, which is really good to see. And the base year was 2009 with a base index value of 1,000, and it is now at 1,132. So when we talk about truth and performance, we're seeing nice, not only value, but also growth in this. So Mark, these are some of the top sustainability companies, right? IBM, Novartis, 3M, Unilever, like we would expect that. But from your perspective, you know that there's a lot of energy companies that are in there. There's Hess, there's Royal Dutch Shell, there's ExxonMobil, there's Barrick Gold, there's Goldcorp. I think we understand why they're in there, but from your perspective and working with a lot of these companies, maybe you could tell some of the audience members why big energy and material companies would be in a global sustainability index.
Absolutely, Michael. You know, we look at how corporations measure, manage, and communicate their sustainability performance, and that's premised on the ESG, the environment, social governance frameworks. You wonder why it would be somewhat perhaps counterintuitive that energy companies would be in the top index. It's a financial performance index, but it's also balanced on the operating performance. Now, we talk about oil and gas companies and sustainable development. There certainly are opportunities for them, and they demonstrate in practice for those companies who make the index and performance quartile, right? They look at the license to operate. Let's think about that for a second. Take a deep dive, connect some dots.
Right. What does that mean, license to operate?
What it means is if you're an oil and gas operator and you're developing globally, you're investing in the community to access natural resources, to harvest those in a production environment and bring them to market. Before the company begins its drilling process, they do an environmental and social impact assessment. That's foundational, and table stakes, if you would, to establishing the regulatory compliance protocols as well as the operating permit, the license to operate. So when we talk about social license to operate, that's a foundational investment.
Right, right. And we're hearing more and more about that social license to operate. And with social media and the news and where we're talking about it,
absolutely,
everything comes to the forefront. And we're going to talk about that more and connect the dots.
And from the operational perspective, that's a fundamental operational excellence. They can prove performance on their capital and stewarding their resources. They're investing. They're realizing the return on that investment.
Right. So let's connect a little bit of the dots here. So our next index would be the Seacrest Global Clean Energy Index. Seacrest Investment Management is based out of New York, and it's some former executives from Morgan Stanley. They do an excellent job in terms of all assets under management, but we collaborated with them to create a Global Clean Energy Index back in May of 2009. They also have outperformance, so it started with a base index of 100 and is now at 149, so more truth in performance. Now, what I like about this index, not just the fact that I helped create it, I mean, because that's always good, but what I do like about it, coming from Wall Street, is that these are not pink sheet companies. These are companies that are actually listed on the New York Stock Exchange, the NASDAQ, the Toronto Stock Exchange. They have a market cap between 250 million and 10 billion. They have revenue, they have clients, they make things. They are part of the industrial background and supply chain that feeds into the NASDAQ index. So they make these companies more sustainable. So Mark, if you look at some of the recently added companies, we have Progressive Waste Solutions, LG Display, Entergis, Waste Connections, MCOR. These are companies in some hot new sectors in terms of waste management, LEDs, OLEDs, distribution and cleanup of hazardous and non-hazardous waste. Across all these different industry segments, what do you think is going to be maybe some of the hottest ones over the next 6 to 12 months?
I would follow the money, if you would, on the operating investments that companies are making today. Largely energy demand, energy efficiency programs, water performance, and likely clean power. Those are three major sectors where you'll see companies, and you follow the investments that the corporations who are taking that sustainable development imperative, they're investing in their business model to innovate. They're investing in energy demand consumption, operational efficiency improvements, the energy material waters aspects of their operating model itself.
Right, water, water, water. We hear a lot about water, but what about the megawatt? Energy efficiency, isn't that one of the most cost-effective ways to lower your footprint?
It is indeed. It's not only in the demand side of the operating itself, but it's also how the corporations themselves will partner with some of these innovative companies as well as the investor-owned utilities to think through generation. It's not just a one-way push, it's a smart grid investment. You'll see, as we see often, how corporations are investing to, say, go off the grid, but it's also essentially where the customer becomes the partner in generation with the utility, and that reduces operating costs and creates new financial investment opportunities for both parties.
Right, so in your experience with the utility industries, aren't these some of the companies that will help make them when we go into some new industrial revolution or we go into the new green economy, aren't these the practical companies that could make a utility or a big oil and gas more sustainable and actually affect their performance in a real way?
Absolutely. This is the foundation. This is where the capital's going in this somewhat staggering economy. You see the restart and the global growth opportunities. These are flagship companies to track.
Right. And I guess, one last point, like you hear something like Solyndra, right? So it's like, all this government money went into it, but it was really an idea, and it's out there making this product and then going to do it. What I like about these companies is they have the client demand. They're not building it and then looking for an audience. They actually have more demand than they can handle, and that's reflected in, the P&L, the balance sheet, and the 10K. So it's practical.
It is foundational.
All right, so let's go to the last little piece here in Truth and Performance, which would be the Southeastern Corporate Sustainability Rankings, which covers the 6 Southeastern states. And we have the top winners for each one of the individual states. Let me just pull this up in front of me so I have it. For Alabama, it was Vulcan Material Company. Florida was Carnival. Georgia was UPS. The winner in North Carolina was Bank of America for the first time. South Carolina was Sunoco, and Tennessee was FedEx. So of note here is that UPS won for the second year in a row, but Coca-Cola was very close behind. We like competition, good for the investors, good for the consumers, good for everyone. UPS was a big winner, and we're going to talk a little bit more about why later on. But Mark, you had joined me not just in the event, but actually in the rankings for the first time. MetaView and CRD Analytics collaborated to incorporate leading performance indicators, which we could talk about in terms of this new lens of sustainable development ROI. So why don't you tell the audience more about leading performance indicators and what we did here?
Sure, Michael, absolutely. It was interesting, the third year running for the Southeast ranking, the 6 geographic state model. And notable, first off, before leading indicators, is the foundational increase in reporting, some 200+% year over year, right?
That's right. There was a 250% increase in the number of companies that went from non-reporting and laggards to intermediate adopters, leaders, and champions, which is operational maturity.
Absolutely.
Which they can only get from both reporting and performance.
Exactly, and this is where companies see the opportunity to tell their sustainability, the story to their stakeholders in the marketplace. It drives demand on the customer side, and it drives their culture to look at the opportunities for investing in their business model. So many of the companies were premising their reporting on the GRI index and the indicator and the CRD Smart View model,
right.
Which is premised on GRI. Now,
which is lagging performance.
Absolutely.
The results.
So, the lagging, and it's a look back. So we wanted to add in the dimension of leading. So if GRI is what to report on ESG-wise, leading indicators ask you how well are you stewarding your capital? Do you have a framework that's the 3D sustainability lens for how you use and view your business model across the enterprise? How do you structure the innovation process? What are your capabilities internally in your supply chain, across your value chain, structurally? Where are the risks and where are the opportunities? And how are your capital investments being played out or in your operating budgets to manage those investments? So that was a fundamental, and if I recall, it's 25% weight this year for those companies.
Correct. And it's a pretty painless process, and we developed it so they could fill it out in maybe 5 to 15 minutes. But it gives companies a chance to really start to tell their sustainability story
Right.
in a more in-depth way. So we've incorporated these qualitative factors that look at the sustainability framework, looks at the organization, looks at how well they're innovating, looks at their performance measurement, but not just a check the box, are they doing it, but how well are they doing it, and how well are they planning to do it down the road? And is this all tied into their strategy? You talk about what? The overarching sustainable development strategy. Maybe you could elaborate on what the lens looks like for these companies, and a little bit more about the type of companies that we were both able to, I guess, evaluate, and what did it look like through that lens?
Absolutely. So you have the broad stroke, as Carol will come on later on and talk about the cross spectrum of industry. We have energy companies, we have commodities companies, we have consumer products and goods, we have apparel companies. So
it's companies that make stuff again.
Companies that make stuff.
And transport stuff.
But companies who consume energy, materials, and water to make that product.
A lot.
Yeah, and they'd link that energy, materials, water, that recipe for their business model, if you will, and tie that back to what they report on, environment, social, and governance. There's the platform for the investment. So where are those risks? Where are the opportunities? And how is the company measuring that value? Now, what we do see, what's interesting in talking to some of the companies like UPS, for instance, or Vulcan, is how they're investing their capital. And it's not just the energy efficiency programs we talked about earlier.
Right.
Those are happening. That's part of the mainstreaming of sustainability, right? But for the leaders who are being recognized, they're already looking at the next step, and that includes product differentiation around those investments on environmental attributes, looking at market share relative to a forecast of new revenue based on a extended product life cycle, or perhaps a new product that comes through innovation and ideation. Through that lens, they see the risks, they see the opportunities, and they marshal and steward the capital and resources accordingly.
Right. And as a predictive lens, I think the investment community is really going to appreciate this, because they're looking for more and better information so they can make better investment decisions. And would you agree that maybe a company like Mohawk Industries, that again is a material-based company, I think that they've been able to embody the sustainable development ROI, because, and we could talk about this, they have in a very short period of time drank the Kool-Aid, in my opinion. So it's not just in terms of putting out a nice report, but it's the actions and the policies that are put in place. So they actually have a chief sustainability officer. They actually have a subcommittee on their board that meets quarterly and gets reported up from the president and the CSO. So when we talk about, where are you, you want to find out where you are along the way, not after it already happened.
Absolutely. That's foundational to the investment. It's foundational to the reporting of the story, and it drives behavior internally, as well as we link the operations story back to the financial markets, how that company's chartering its sustainable development journey. So
just to wrap up on that, would you agree that we're in our collaboration on the lagging and leading, that this is a future trend? Do you think we're too far ahead of the curve, or do you think other folks will also start to follow the same path?
Well, yes, it's going to be the future. We in our collaboration and True Transparency, many of you in CRD are collaborating to generate and develop the next generation NASDAQ Sustainability Index framework, inclusive of leading indicators. But one foundational aspect from the feedback loop we got from this particular survey instrument was that many companies said, wow, these leading indicators are driving us to think and answer the hard questions. We're looking at structural investment and where the company's going. It enables them to make the business case. For those EHS and sustainability leaders, the CSO at Mohawk, right? They're looking at, well, we have operational budgets this year. Where are the investments going long term? And you think about where to position the business. Many of the bets you make capital-wise on investing and innovating the business model are not this quarter or next quarter, they're next year. So how do you establish the business case framework and ROI? And many of the companies said that leading indicator set enabled them to create the narrative to chart the business case internally and then link that with the numbers operationally, and it became an obvious decision point.
Right. I remember a couple of people saying, it gives us a new perspective or a new lens to look at our own business, and it helps us in terms of our articulation, telling our story to our bosses and the executive suite. So they seem pretty positive overall.
Absolutely. So we look forward to that.
Yeah. Stay tuned. So let's go on to the next segment.
Absolutely. So let's move on to the Connect the Dots segment here. And one of the things that Michael and I love to do is, as you can tell perhaps, is just talk about how companies are measuring, managing, and communicating their sustainable development investments. Those stories that come out from the operating companies to the global markets and the financial communities. through our collaboration with many of those companies, we'd like to share some of the deeper dive perspectives. And specifically, now that we've looked at the truth and performance on financial performance measurement, let's look at some of the operating aspects specific to environment, social, and governance, where the companies are now reporting, but then internally operationalizing those opportunities.
Right. So why don't we start with environmental? Everything is all connected, so we're really just going to use the ESG pillars as a starting point. So we'll use that as a starting point, and maybe piggybacking off the Southeastern rankings, two companies that we thought are of extreme interest would be Coca-Cola and UPS. So Coca-Cola is the global brand, and while it is brown sugar water at its essence, it is the best brown sugar water out there. And they have
1.5 billion bottles per day?
1.5 billion. So it's not my opinion. They're selling their product, so there's huge demand for it. But they face enormous resource constraints, and to make all those 1.5 billion bottles, they must use a lot of water.
Well, fresh water is the foundational feedstock to their product. Let's look at that and understand what that means. So here's Coca-Cola with an enterprise operating footprint of many bottling companies globally. So they operate globally and locally. And with that water issue, they had some pushback from stakeholders in the communities.
A little bit.
But it's a supply-demand side. On the supply side, they had to ensure continuity of the water as a feedstock into their production facilities, right? So with the pushback, they need to partner with the local communities, and they've done a fantastic job of investing and partnering with those communities to look at risk analysis of water security, if you would, as a supply chain issue for the company itself. And that's been an investment. Their CEO's been talking about it. It's a great storyline for how the company has taken through that 3D lens of sustainable development, the economic, environmental, and social. They've evaluated their risks, they've looked at the fundamentals and the opportunities, and they've now done a partnering outreach as an investment.
Right. And I think, when we talk about the reporting, the performance, and then the results, I think that they do an excellent job. So they just released their new sustainability report. I recommend going through it. It's very easy. It goes at that top level of the maturity. So they're about not just reporting everything, but telling their narrative and also talking about their targets. When we first looked at them, we said, okay, well, maybe they just outsourced all of their carbon footprint and all their water by setting up these bottling companies. But no, we reject. They actually take that into account in terms of their footprint, and they take that as a responsibility, as an accountability to help all of those subsidiaries also manage to the best of their ability.
Absolutely.
So they see the supply chain and the throughput. UPS, United Parcel Service, logistics. They are a leader by every definition in terms of sustainability reporting and performance. And whether you agree with it or not, we see the data, and they believe in ultra transparency. And at the same time, I think they have some humility to say, yes, we report everything, but it's not enough. And just because we report, we're looking at new ways to analyze that information to improve how we manage our capital and how we can produce financial performance and shareholder value. And what leaders do is, if there's a metric that's really important to them, but it's not there, they will develop it. And that's one example of what UPS has done. So they're actually looking to track the energy intensity by each one of the packages, which I thought was a really interesting, example of innovation.
It is an
What's your
innovation.
thoughts on that, Mark?
Well, it's an opportunity to assess the data relative to the different products they have in the marketplace, and they're a logistics company, so their business model is about transportation. So those analytics around use of their business platform and the customer end use of the product enables them to get that lagging indicator perspective, and looking forward around those leading indicators, and they can do the what-if scenario planning to do the product innovation. It's a significant opportunity for their investment. That they're creating their own metrics that matter, which we'll talk about later on with Carol.
Right. So, social. What's going on in social?
Well, social performance. I had a chance last week. I attended the Sustainable Brands Conference in San Diego, and props to a successful conference for the organizers. And as I mentioned earlier, the CNN executives were there, and they presented their Freedom Project story about global child slavery. And in a sidebar discussion, we talked about the fundamental issues around what they see. And CNN charted this project to daylight these issues, which relevant to the ESG we talk about. It's about labor and supply chain risk.
Oh, absolutely.
Right. But one of the things they mentioned was that while we talk heavily about climate risk and carbon and environmental footprint, social performance and labor issues are really under the radar in the marketplace.
It's interesting you say that, because I've heard that a lot from the investment community. Like, how do we really measure social performance? Because some of the issues are only material to to that industry. So that it's not the universal ones. Yes, you can look at the diversity of management. You can look at they have a human rights policy, if they did the check the box this and the check the box that. But what are the most material social performance risks when you have a big, say, oil company or mining company?
Well, there's a number of social risks around investment in indigenous peoples, local community development. That shared value term you hear often is about the capital investments and how the companies themselves bring their own human capital and resources to bear in a particular community in which they operate, but they also partner with the local resources, i.e. the professionals, the technology services companies. But what I'd like to bring it back to is you think about some of the structural investment and the issues around the labor issues for the CNN project, right? They're talking about this, and they had mentioned one of the projects was the cocoa project, and the cocoa industry, which is 75% of global cocoa production is in West Africa, right? And the majority in the last 10 years, now the majority of that production and labor has been child labor. So those children are aggregated into what is global slavery production. Now, if you're a corporation, and there are many corporations that have been, there's top 10 producers that comprise about 80% of the market cap in this space. There's Mars, there's Hershey, there's several others, Nestle. Those companies have now, through stakeholder engagement, if you would, have committed to onboarding certain protocols and improving their operations.
Right. We're seeing more of that industry collaboration.
Exactly.
Right. We've talked about a little bit more with Carol. You know, that reminds me of one important story that came up a couple of months ago. It was for Hershey's, which you know, everyone knows Hershey's, Pennsylvania. They have a big theme park. But what hit the cover of the New York Times is the fact that they were using a third party for finding them labor. And in terms of finding them labor, they went to developing worlds and they found students to come under a work program. But that work program turned into basically a slave labor shop in Pennsylvania. Now, even though Hershey's isn't cutting them a paycheck, since they're putting Hershey's products in the boxes, and then they go and they're revolting and they're holding up signs about Hershey's, that would seem like a direct risk. Even though, like I said, it's not a paycheck, but it's so close to the supply chain and the product. So from an investment opportunity, you know, to me, that makes me nervous.
Well, let's bring that back. So we're connecting the dots here again. We're talking about ESG. This is the social performance indicator, right? This is labor standards, human rights, fundamentals. And you would link that reporting aspect back to the operating parameters of the company. This is fundamental to the supply and demand side of your business model. On the supply side, the human capital is your labor source for production. So your forecast production environment, right, is based on that premise.
Right.
It's based on slavery as a trade source. You've got risk to operations. That's economic sustainability 101. Now, on the demand side, you've got a customer basis that if they are aware of this opportunity and they make the decision, there's a revenue risk on the demand side because customers are now boycotting your product.
Right.
Fundamentals.
And we've seen that over and over again. So let's talk about the last segment, which is governance.
Yes, indeed, governance.
So
governance gone wrong.
Yeah, governance gone wrong. So we were talking about that the other night, and there's really no shortage of stories for governance gone wrong. But you know, when you have the CEO Jamie Dimon on the floor of the Senate Finance Committee explaining how, you know, why they lost $2 billion by the nickname the London Whale, and even though that he did know about it, they assured him that it was an aberration and that it couldn't happen again. And I have tremendous respect for Jamie Dimon and what he's done with J.P. Morgan Chase to weather the storm. So, but the fact remains is that without the proper, you know, basic checks and balances in there, and not being able to connect or be able to thwart the stop-loss gap. Like, why can't we stop it at 100 million? Why can't we stop it at $1 billion? Why did it have to get to $2 billion loss before we're finding out about this? It comes down to really basic governments and stopgaps in there. What are your thoughts on that?
It does indeed, and at a fundamental in the operating sense, it's about management systems. It's also about culture. It's about establishing that leadership framework. So there's an opportunity, and there's, as we mentioned, there's no shortage of governance gaps in execution. So let's look at another example in the energy business. Just recently, Chesapeake Energy, a oil and gas development company, both the CEO and some of the directors of the board, who actually just last week were voted off for their governance lapse issues around the CEO taking equity position and borrowing capital against corporation assets for his private portfolio. That has been a fundamental issue. And again, another example of how they have the impact of that. Loss of market share, loss of capital position, a number of impacts.
All right, just for a second, going back to JP Morgan, I think they lost $30 billion in market cap, 19% stock slide, Chesapeake, the same thing. So again, that's why as an investor, we want to be able to take all those factors into account. So
absolutely.
Could go on for an hour here more, but
we could indeed.
Let's move on.